Markets took further relief in May after Macron won the French presidential runoff, as he is perceived to be pro-reforms and pro-Europe. At the same time, uncertainties about the reform agenda in the US triggered marginally lower yields, both for treasuries and European bonds. Furthermore, credit spreads declined and equities prolonged their positive trend, also due to positive earnings results in Q1 and the solid global macro momentum. In the euro area, macro surprises remain at high levels despite the fears about rising protectionist measures. Global trade is providing a tailwinds to the global macro backdrop. The continued recovery of the labor market and the pickup in investment activity will help sustain the economic expansion, even though underlying prices pressures will recover only slowly from current low readings. In the US, macro surprises were weak recently, but we expect growth to recover going forward from a weak first quarter, and catalysts will be solid consumer spending, some pickup in corporate investments, also due to positive earnings growth. Overall, the political uncertainty will continue to weigh on markets, albeit to a lesser degree after the Macron's victory in France. Notwithstanding such political risks, we see global real GDP growth and global inflation at 3.3 and 2.7 respectively in 2017. We anticipate the US economy to expand healthily. However, the risks to President Trump's ambiguous fiscal plans have increased recently. We expect a small boost from the tax reform at 0.5% of GDP and to become effective only in 2018. In Europe, the Frexit risk is off the table. Polls suggest that Macron's party could get an absolute majority in the June legislative election. If this becomes true, he will have the power to go ahead with the reforms, starting from the labor market. A positive outcome may help to lift the potential growth rate for France and euro area in the longer run. Italy is the most critical issue. Here, major parties have found an agreement on the new electoral law, which increases the likelihood of snap elections in early autumn. Government formation will likely prove very difficult, and there is a high probability of a hung parliament. The positive aspect is that a Eurosceptic-led government looks unlikely, and so does Italexit. That said, markets are likely to keep speculating about political risk in Italy for the months to come. The described solid macroeconomic momentum will trigger a continuing normalization of monetary policy by the Fed. The ECB's wording may also turn less dovish, and discussion concerning tapering should come into focus in the next months. As a result, two key sources of upside pressures on yields will continue to influence investor sentiment: a solid macroeconomic momentum and the outlook of less accommodative monetary policies, especially by the Fed. For these reasons, we recommend a below-benchmark exposure to core government bonds, namely bonds and treasuries. Southern European bonds are also an underweight after the good performance achieved since mid-April and increased political risk in Italy. That said, following the rally in equities by nearly 10% year-to-date for the Morgan Stanley World, valuations look stretched, especially in the US. The price earnings is near to a cyclical high, as the one experienced only in 2004 and 2015. Given the persistent disturbances from the political side, the risk of temporary setbacks on financial markets has increased. To be clear, we still expect risky assets, European equities and corporate bonds to continue to outperform government bonds. However, given the mentioned risks, we favor a somewhat more prudent exposure than over the past 4 weeks. In the equity space, we continue to favor the euro area and the Japanese indices. Among sectors, we favor discretionary, telecoms, and financials. Thank you for your attention, and we keep you posted.